Mastering Technical Analysis. Welcome back. This is Otienofx in partnership with Skitsoft Solutions. Now, in the previous videos, we've talked about having a technical edge, just like the casino have an edge over the players. How do we get this edge in the market? We get into technical analysis, and technical analysis help us to anticipate the probability of the price movement. Now, every single day, the market price can either go up or down. So if you want to toss a coin every day and go long or tails or heads, in the long run, you're going to be right half the time, right? This is random. So, do you want to be right more than half the time, just like the casino is always right more than the player? So, to do that by studying technical analysis. And technical analysis is about the study of collective emotional patterns that are captured on stock or forex price chart. So, you can understand that on a short term, when I say short, I mean less than 3 years. In a short term, the stock markets or the forex markets are always emotional. Price go up and down every single day. So that's why you see the reaction of going up and down every day. It's never logic in reality, but it's emotion. That's why you'll see stock or currency going up and down. It's a psychology. As a psychology, you are studying your patients. So how do you anticipate your patients' emotions? You look at their facial expression, for example, body language, postures. So when you look at a forex chart, it's kind of like looking at the body language or facial expression of the currency pair or the stock. So from there you can tell what are the emotions driving the currency pair. And then it's not a guarantee, it's just a probability, just because we can study the market's emotions. You don't have to be right all the time, but you can always be right more than the number of times you're wrong, because you have this statistical edge of the market. So let's take, for example, this stock, Domino's, where it was selling at $14. And what happens within a span of around 4 months or 3 months, it went from $14 to $7. Right? How did that happen, right? Now this is something crazy. It has nothing to do with the company or the currency pair. If you remember the date, 08 November, September, there was a financial crisis, meaning people panicked and people started to sell their stocks and shares or currencies because they were afraid. So there were more sellers than the buyers. That's why the price collapsed. Now you may say, hey, that's a great opportunity, right? Let us sell, because the company is selling at half price. But what would have happened if you bought at $7? 1 month later, you went to $2.80. So you can see that within a short term, the stock or forex market is irrational, emotional. Not knowing this is that when they do forex or stock, they say they don't get it because they bought when it was going down, or they bought when it was going up, and then the company started losing money or the currency pair started collapsing. Because it got nothing to do with logic. That is part of emotions. And once you understand that, you will begin to earn consistently in a short term. And if you study this emotion, you can study them by studying price pattern, collective psychology. So imagine emotions of the market. You can read and learn to be able, for example, sell at $12, and when it collapses and goes back to a $3, you buy it at there. Or you can buy it at $3, $4, all the way to $14 and avoid the stretch. Could we do that? Absolutely. And I'm going to teach you how to read price and trends in the chart. That's, you'll time your entry into the market. So let's begin. Now, before we go into specific strategy, let's understand the fundamental that goes behind it. And the first principle, and the most important, is that market price or stock prices or forex price discounts everything, all information. That is why in a short term, as a short-term trader, reading economic news, fundamental news might not be really that effective. It might be a complete waste of time. Why? Because market price is the leading indicator to all this fundamental data. And by the time you read this fundamental data, it's too late. The price is already moved in the intended direction, and you're always late to the party. Let me give you an example. Prior to the 2016 US election between Hillary Clinton and Trump, the stock prices were going down. Now, what happened was, the moment Trump won the election and the news was announced, within a split second, catapults prices went all the way up by 10% immediately. Why? Because Donald Trump had promised that if he wants the election, he's going to do some great things, build worlds, infrastructure, spend on government, building bridges and infrastructure, right? So the moment Trump won, the market anticipated that Caterpillar, being a construction company, would get all these construction orders from the infrastructure sector, and as a result the price went up by 10% in anticipation that it will happen. So this information that is gonna happen in the future has been priced into the stock immediately. Now I have a question for you. Has the government actually spent on infrastructure? No, not yet. Has Caterpillar gotten all these tenders? No, not yet. But the share price already anticipates that it will get the orders, right? Now, by the time the government really spends on the infrastructure, or the Caterpillar really does the work and shows the profit that will increase the share prices, by that time the share price will have already whizzled up. And if you were to buy the share price at that time, look at this fundamental data, you will always be the last one to the party. And the most people who buy based on fundamental find it that the moment they buy, the price drops because they are late. So fundamental news always causes you to react too late. Let me give you another example. This is how the stock market cycle with the red line corresponds to the economic cycle shown by the green line. And as you can see, the stock market or forex market cycle, which is determined by stock prices, does not move together with the economic cycle, which is mentioned using GDP. In fact, the stock or forex markets leads the economy by 6 to 9 months. So here's an example. The stock market is at the red line, was an all-time high in October, and at that point of time, and that was market top, as you can see. So now the moment the financial crisis hit, what happened? The stock market reversed into a downtrend. So over here you can see the market price going down, right? Now here's the interesting part. Notice that as the stock price is coming down, the economic GDP cycle is still going up, right? Why? Because the stock or the forex market anticipates that the economy will contract even before it happens. The stock markets lead the economy by 6 to 9 months. So people who read economic data will be late because they read the data slightly later. So for them, they might read that what is happening is going up, but they buy more, and then the stock side is going down, and then they start to wonder, how come I'm reading the data so well but the economy is still not giving me profits? It means by the time the economy starts to contract right here, or GDP starts to fall, by the time they start to make the sell trades, you can see that the red line has dropped by 70% to the bottom. So people who relied on reading economic data and saying, hey, that economic is doing badly, I better sell. By the time they are selling, what happens? They are selling close to the bottom and they have lost 70% of their money. Conversely, you can see over here, this was the market bottom, and this was February 2009. So the market started to rise at that point, and it started a reversing trend going upwards. So notice, as the stock market is going up, the economy is in full recession, right? So many people using economy will be selling, or they will say, hey, I will not sell because it's as a recession, and they don't understand that the stock market already moving up. That's a buy opportunity again, because again it leads the economy by 6 to 9 months. The market anticipates that the economy will recover even before the economy. So what do most people do? Most people will wait for the economy to recover, early recovery right here. They wait for it to recover, and the moment they see that, hey, the economy is recovering, and they say, I better invest in the currency pair or stock market, what happens? By the time they invest, they will be buying near top of the stock market or the currency market. That's why most people lose money, because they are looking at the wrong thing. They are looking at the economic data, at the fundamental, which always cause them to act too late. So remember, the entry and exit decision must always be based on the price action, where the price is moving.